In this webinar, we will look at equity valuation, and we'll see what we mean by the value of a stock, and why do we need to find the value of a stock, and how do we find the value of a stock, and is it different from the price at which the stock is available in the stock market. And we'll also look at companies that generate so-called value for shareholders. Before that, we will just quickly recap what we did in our previous webinars. In the previous webinars, we looked at how to identify the benchmark, the broad universe of stocks, and then from that, how to apply our internal criteria in order to select or in order to filter out the investable universe. Then we looked at how to analyze companies in our investable universe. So, what are the criteria? There are four. We saw that there are five broad pillars of analyzing companies. These are growth, profitability, innovation, strength of management, and the risks facing the companies and how they mitigate those risks. So, on the basis of this company analysis, we whittle down the investable universe into a list of companies or a ranking of companies in our portfolio and in the order of attractiveness. So, now it is time for us to value the stocks of those companies. And obviously, this helps in allocating our corpus across the companies in the portfolio. So let us now look at valuation and some philosophical aspect of what valuation is. Just blindly jumping into Excel spreadsheets and doing valuation modeling, let us understand valuation and the concept of value creation from the aspect of a company as well as from an analyst's perspective. Why is it so important for a company to create value? And what are the drivers of value creation? And how you, as an analyst, can identify companies that create value for their shareholders. So, value creation, the classic definition of value creation is basically it is created, value is created by investing capital, generating free cash flows at rates of return that exceed the weighted average cost of capital on a sustained basis. This rate of return is called the return on invested capital, ROIC. Then this is a measure of value creation that is used widely both from a company's internal performance measurement as well as from an external analyst perspective, what investors look for when they want to invest in the company. So companies create value for their shareholders by investing capital to generate future cash flows at rates of return which are higher than their cost of capital. Companies which outperform their peers invest more into opportunities and achieve higher returns and growth rates. Now, value is very intricately linked to a company's capital allocation strategy. So it depends on the management looks at various projects or various capex opportunities, and then does the analysis as to which project to choose or which investment opportunity to choose, so that it can produce maximized returns on their investment. And so basically, capital allocation is the most efficient way to link sources to uses of capital. And investors are increasingly looking at value creating growth. And future cash flows should show an increasing trend in order for the company to have flexibility to reinvest in opportunities. So, not only should the return on invested capital be greater than the weighted average cost of capital, but the future cash flows must also show an increasing trend. Because free cash flows is a very important aspect of value creation, and so superior value creation, as we said, stems from excellent capital allocation decisions. And those decisions must result in investment in high return capex, and they also result in predictable and sustainable growth rates. And as we saw earlier, return on invested capital, which is greater than the WACC. Managements which quality company managements strive very hard to invest for growth, and ROIC, which is a key measure of value creation, is looked at very carefully by boards of companies, and they are linked to executive compensation to improvements in ROIC. And as analysts, you must discover which companies have increasing ROIC trend, since those companies create value. And studies have shown that there is a strong correlation between increasing ROIC and corresponding increase in stock price. So that's what this slide says, is that now growing cash flows can either be reinvested in growth projects or returned as payouts to shareholders via dividends or buybacks. But the latter option is not really one that creates values. Shareholders would rather, or I would say most shareholders would rather that the company reinvests in the business and produces enhanced returns. Many companies are reluctant uh, because they feel that they can't deal with the macro uncertainties or the volatilities or growing interest rate scenario, or they can't deal with the prevailing situations in terms of the economy or in terms of the sector dynamics. And that really is an indication of the strength of management. Good managements have ways in which, or rather, they have the knack of dealing with these challenges and yet produce growth. So these are the managements which produce enhanced value for their shareholders. And such companies are strong in strategic capital budgeting, investment project selection, and governance. Now, interestingly, you see how these link to some of the first principles in terms of capital allocation to projects, like your NPV and IRR and time value of money. And so, as an analyst, you need to be aware of all these first principles in order to proceed further and in order to understand how companies allocate their capital. So, now let us look at another interesting question as to what is the value of a stock. Some definitions state that the value of a stock is the true worth of the stock, that is, based on fundamentals, the growth and capital allocation, etc. So how do you define true worth? And so that is the main question. True worth is one that is obtained from the fundamentals of the company, how it is dealing with free cash flows, or how it is dealing with, or how it is doing capital allocation, and how it is reinvesting its cash flows into projects, and how it is maintaining growth on a sustained basis. But there are others which define value as the price the market is willing to pay. Now, these are also knowledgeable people who believe in what is known as the efficient market hypothesis, EMH. Now, EMH says that everything there is to know about a company is priced into the stock, meaning all of the information is reflected in the price. And that there is negligible opportunity for an investor to capitalize on any so-called inefficiencies in the market and to make money. And these folks are proponents of what is known as passive investing. Some of the prime examples of passive investing are index funds and strategies like ETFs, Index Plus, or even something called smart beta. Now, sometimes market is influenced by fear, greed among investors, or by macroeconomic news, global events, company-specific news, leading to volatility in stock prices. Today, more and more how investor capital is being allocated to passive strategies like index funds, increasing risks in the world with respect to global wars taking place, oil prices and uncertainties in political scenarios across many countries, in some of the hotspots across the world, which affect supply chain, etc. So that is why, rather than taking on risks that can be mitigated, investors think that they could rather invest in passive index funds, like the S&P 500 or the Nifty, or this is where market price differs from intrinsic value, leading to opportunities that active managers can exploit. Now, on the other hand, active managers believe that the market is not efficient, and at certain times it misprices stocks. A famous quote from Warren Buffett is that price is what you pay and value is what you get. There is one section of investors who believe that the price is arbitrary and value is fundamental. Active managers contend that every stock has a true value or an intrinsic value at any time, fundamental to its operations and future prospects. So the market may price the stock below this true value or above the true value. Now, these present opportunities to active managers who wait patiently to exploit this mispricing to their advantage. Also employ what is known as the margin of safety. This means that the investor buys the undervalued stock at such a discount that there is a large difference between its intrinsic value and the market price. Now, when they buy stock at a deep discount to the market price, the smart money realizes this, and the demand for the stock rises as others to join the party. Point, the because of the demand, the price of the stock becomes quite high and it becomes expensive, and so they that becomes a good selling point for the managers, and they take money off the table and invest in another undervalued stock. In this regard, take the example of Ola. Now, recent listing price was 76. It opened at a premium and even rose to 150 within a few days. Investors were gung ho about the first pure play EV company, but in the euphoria, they forgot about industry challenges, questions about the pace of EV adoption, and the mounting operational losses of the company. In fact, market depth even touched 4 is to 1, and the stock even hit the upper circuit. But then the price quickly dropped to 114 recently when the realization set in that the company still has a long way to go. So this is basically, an example of euphoria, which caused the price to shoot up to crazy levels. So this market price was driven more by investor sentiment as opposed to fundamental based reasoning. So that's how this summarizes that the market price differs from value. It characterized by factors other than true fundamentals, which is macroeconomic news, investor psychology like fear and greed, and supply and demand. So many companies are quite susceptible to short-term news cycles, resulting in fluctuations in stock price, and so this presents a opportunity for active managers to take advantage of this mispricing. So therein you see the difference between the EMH, which is the efficient markets hypothesis, and the active management practice. And which one is better? It depends. At different times. Value at different times. Active management is on top, and at different times, other times, passive investing is on top. So it's basically depends on a lot of things. It depends on market cycles. It depends on economic situation. It depends on sector dynamics, etc. And let us now look at how we calculate the intrinsic value. Now, we know that the sum of the present values of all expected or future cash flows within the holding period is the present value of the or the intrinsic value of the firm. So the denominator, which is used to discount the future cash flows, is the discount rate, and this is also called the cost of capital. It is, in fact, it is the weighted average cost of capital. Why is that? Because we use both equity and debt as the invested capital, because and it becomes necessary that we use WACC, that is weighted average cost of capital, instead of just cost of equity. Now, the discount rate, what is this discount rate? It reflects what the investors expect or require to earn by investing in the company. And this is the minimum return that the investors expect from investing in the company. And therefore, expected rate of return and the cost of capital are considered to be same. So now, how do we forecast future cash flows? The future cash flows can be forecasted by first building the revenue forecast, then forecasting income statement, balance sheet, and then obtaining free cash flows and ROIC. Now, you may wonder from how and where you can get this data, or where can you source this data. Typically, this is some of the data is available in the financial statements. Some of the data should be calculated. But luckily, that task has been already done for you by so many market and company data providers of every type. And so you don't have to waste time digging into financial statements. You just decide what is the kind of data you want, and all of this standard data is made available to you overnight while you sleep, and your programs can churn away at the models using that data in time for your morning meetings. Now, you can also generate custom data using the standard data items. So it is important that we don't get mired in the minutiae of free cash flow calculations beyond the well accepted theory. Such an exercise also does not produce much incremental accuracy. So, as the saying goes, it is better to be approximately right than exactly wrong. So if the firm's ROIC is greater than the WACC on a consistent basis, it creates incremental value. That we know. The discount rate also reflects the unpredictable, the risks of unpredictable or unstable cash flows. So by investing in the company, investors require a higher expected return by investing in a risky company. What does that mean? Investing in a company which has either unstable cash flows or uncertain cash flows. And so that's why it's called the required rate of return. And so now what we do is just little elaborating on the weighted average cost of capital. We apply the discount rate to each year's free cash flow forecast, considering time and risk. Now, as we mentioned earlier, this is available to all investors, equity and debt. So therefore, the WACC blends the rate of return required by equity holders as well as debt holders. So let us now look further into, what is this WACC. Now, we know that to value a company using enterprise DCF, we discount a forecast of future cash flows by the weighted average cost of capital of the firm. So, as an enterprise, uh, FCFs, that is, free cash flows, are available to both equity and debt holders. And so, WACC must include required return of each type of investor. And so here we see that there are three types. There are three things rather we need to estimate. One is the cost of equity, which is here KD, rather KE. Then the after-tax cost of debt, which is the KD. KD is the cost of debt, and then we apply the tax shield, and so that is the after-tax cost of debt, and then the target capital structure of the company. Note that none of these are directly observable. That is, you don't get these, typically you don't get these in the financial statements. So therefore, we have to use models, you have to assume certain things in order to estimate them. And also another thing is that the cost of capital is also used to allocate capital across the firm. So because when you allocate your capital across various projects, you need to apply the cost of capital in order to evaluate the, whether the project is a go or a no go. So that's why the cost of capital is also called a hurdle rate or the required rate of return. So what we see here is that there are three important components of WACC. One is the cost of equity, and the other is the after tax cost of debt, and then the cost of the target market value of equity and debt. So cost of equity you can find by using the capital asset pricing model, where which in turn has three factors, which is one is the risk-free rate of return, then the other one is market risk premium, and the third is an adjustment that reflects each company's riskiness with relative to the market portfolio, that is beta. Stocks with beta or high beta are riskier, reflecting that a higher required rate of return or cost of equity. The after-tax cost of debt is estimated using the company's yield to maturity, that is YTM, on its long-term debt. If the company's bonds are traded publicly, we can get the yield to maturity directly using fixed income math from the bond price and the cash flows. If the bonds are not traded frequently, then we approximate using the company's debt rating. Then free cash flow is calculated without interest cash shield. And so the cost of debt is calculated using the company's marginal tax rate, and which is TM in the above equation. And then you have, this D divided by D plus E and E divided by D plus E, which are the capital structure of the firm. So we have looked at value from a philosophical perspective and identified drivers of value, and we looked at what is the weighted average cost of capital and how these are used in determining value of a firm. And to put it in perspective, what is very important is the process of capital allocation. And so both from a company, so if you are in the FP&A division of a company, or if you are an external party like an analyst or a potential investor, capital allocation is very important. And as I said previously, in some of the more forward companies, executive compensation is linked to increasing ROIC trend. And so that tells you the importance that companies place in allocating projects for growth and the return on invested capital. And from an analyst perspective, looking at ROIC also is a measure of identifying quality companies um, from this huge investable universe. So in the next um, slide, then we will look at various valuation models. Some of the most widely used valuation models are the dividend discount model, the multiples, comparable companies model, and the discounted cash flow model.